One of the big things that I think people like is that I built the master suite as its own private third floor. So that is just massive. So you have 2 walk-in closets in some cases. You have a shower that's more European design. So you have the bathtub and the shower all in one enclosure. You have views out the back in your own private balcony.
You said water views, right?
And some of them have water views. It also depends on which phase you want. If you want the master to get water views, or if you want to have the water views from like the living room.
Yeah.
Because the living room's stunning. I have big sliding glass doors, 26-foot vaulted ceiling, big balcony that hangs off the front of the RV garage. So for your guests, if you're drinking coffee in the morning or eating breakfast, you could look out that way to the water too. So it just depends on which way.
All right, guys, welcome to another episode of The Report. Today, I got a repeat guest. I got someone doing big things in the real estate space. He controls over $500 million of real estate, and is the #1 man cave developer in the world. I got my man, Ryan Garland. Ryan, welcome back to the show for a second time.
Thank you, man. Round 2.
Yeah, man. Such an amazing conversation last time. We first connected out in Miami.
Mm-hmm.
You hosted a really sick event out there with Jordan Belford. I met Ryan Garcia when I was out there, one of the top boxers in the world right now. Wes Watson was out there, great events. But you came on a year ago and lit it up on the podcast. So many good nuggets and so many big things that you're doing.
You had a lot of hits that time, yeah.
Yes.
A lot of hits.
Big things, dude. And so much to dive in here on today's episode. But first things first, man, you flew in on a helicopter this morning. Did you come out from Havasu or came out from Temecula on your helicopter?
No, I came out from Havasu.
From
so
Havasu?
I got up,
How long is that flight?
Right at 2 hours. So it wasn't bad. It's a lot better than a 10-hour turnaround trip.
What kind of helicopter do you have?
It's a R44, and it's not mine, but I use Eternity helicopters to fly me around everywhere I need to go.
Okay. And you got your pilot right here
watching
the
right
podcast. Yep. That's good. That's cool stuff, man. Did you fly or did the pilot fly?
No, he flies. I just kind of co-pilot, act like I know what I'm doing.
Yeah. I like that, man. I like that. So much to dig in here, man. Give us a snapshot. I want the audience to kind of know, who you are, but give us a snapshot of what you currently own and what you do in the real estate space today.
Yeah. So I cut my teeth really. So prior to 2008, I was more in the mortgage space. Had a mortgage company. When 2008 hit, I kind of got it more into the distressed assets. That's when I opened up the Paradigm brand, just because you kind of had to shift to survive, right? And as the market was shifting, I kind of got into, again, more of the workout turnarounds, REO, short sales, distressed. And so I've always had this kind of conservative outlook and lending money on distressed assets as well, from being a lender, so hard money lending and so forth. And then really it's just fast forwarding to where we are today. Not only doors open for me because I not only found them, but walked through them and continue to push myself into different realms. But we ended up going from kind of more of a private money lender, fund management, asset management to distressed assets, workout turnarounds, selling notes, repurposing all different portfolios, working with larger institutions like JP Morgan, Wells Fargo, offloading some of their dirty papers, what we call it. And then kind of going into lending money to a lot of developers, we got to a point where we were managing the fund control and the construction as well. And if things would go south, we'd have to foreclose and take the property back. So that's how I cut my teeth in construction. So then I got to a point where I'm like, why am I lending money to a bunch of developers building big commercial projects when I just lend money to myself? So that's when I got into raising capital and developing my own projects. So right now we have about $200 million under construction right now, kind of a blend between Texas and Lake Havasu, mostly Havasu. And then with our private lending fund, we have about $500 million in assets under management at the moment.
Yeah, I love it, man. In self-storage and also your man cave development, which we're going to get into, regarding the self-storage, what are some of the things you love about that asset class?
So self-storage, one of the things that I tracked a long time ago was the boom in multifamily. And unfortunately, in 2012, I believe was the largest, I would say there was more divorces ever happening because of financial hardship than ever in history due to the crash. When you have two houses, one house becomes two now.
It's the number one cause of divorce
is financial hardship.
Is money, yeah.
And so when that happened, I really saw a division between households, unfortunately. And that's when self-storage really picked up because people were trying to keep their items. And then as multifamily continued to get bigger, people need, to store their stuff. And even I lived in multiple apartments and never had enough room. So, and then bolt on working from home and having files or, other aspects of your business that you need to store. Self-storage just continued to blow up, but it was kind of one of those asset classes that not a lot of people got into because it's not a pretty asset. It's not a high-end home. It's not a big commercial building. It's just boxes with metal in the middle of it, and it's kind of ugly. So when you start tracking the data, though, it's the income was insane. The difference between what we're doing, because really the boat and RV storage is inside the self-storage asset class.
Mm-hmm.
We really hung our hat just because of I love boats just like you do.
Yeah.
And I'm a boater. And if I could maneuver my career into doing something I love but making money, why don't I build storage for boats and RVs? So we ended up getting into doing more of the larger man cave boat and RV storage units where each unit is actually track map. You can sell each unit. So it's fee simple. So where most people think self-storage, you have to rent these units out and you just store your stuff in there. With the larger units for boats and RVs, you can buy each unit. So therefore it's fee simple. So you can do build to suit, build to rent. You could do, I have buyers for 1031 exchanges, IRAs. I mean, it opens up the floodgates for not only investors that are looking for cash flow, but people that are looking for equity participation on the development side. So, but what we did to kind of set ourselves apart, so if you wear the developer hat, you wanted to build a niche for yourself to build a brand.
Sure.
When you look at our competition that are also in that space, they don't have air conditioning, they don't have temperature control overall, they don't have insulation, they don't have specific garage doors that are more favorable to use in and out. They didn't have plumbing, put into the foundation so you could build bathroom, showers, all that stuff.
Same thing with airplane hangars. Most of them don't have AC, climate control, and very, very bare bones and basic.
Yep. And so to give you an idea, if you could put that infrastructure in, it doesn't cost you that much money. But if you build that, then when you sell it, people can customize it the way they want. So ultimately, I'm delivering boxes for guys, and they're like, hey, instead of me, going and renting that for an office when I know it's maybe one or two people, I can make this my office as well, or I can stay here if I need to, or whatever you need, whatever you do, and you can customize that space. So really what I do is I build these boxes that people want to customize. We can go in there and build bathrooms, showers, kitchenettes, washers, and dryers. So, a lot of people who are boaters don't want to take their towels to their house or, their bathing suits. You can just wash all that stuff there and put it back in your boat and take off. All kinds of stuff. I mean, it's endless what you can do.
Yeah.
And so we just started building a product where people can ultimately hang out at. It's temperature controlled, so it keeps all of your items in good shape. And this is how I caught it. And if you don't mind, I'm going to kind of go on to a little tangent.
I'm curious, like as you're telling me this, because obviously when you have an idea, you test the market and see if there's demand, right? And so I'm sure that you tested the market at a smaller sample size to see if there's demand. What was that first test phase kind of like?
So it was really my phase one of one of my projects.
Okay.
And what I really kind of caught on to was people wanted to live in these spaces because we just built them out so well. I mean, literally, it's a house. You just start putting walls in if you want to. But really what was happening, this kind of backstory, the reason why I wanted to put AC in there is because, and you probably will tell right off the bat, how expensive is the batteries in your boat?
Oh, not cheap.
Dude,
and you want to put lithium batteries, it's not cheap.
Thousands,
yes.
I mean, $12,000, $15,000. Some of these boats and RVs, as they get more expensive and more sophisticated with technology, their batteries are very expensive. One of the times three times I had an old center console. My batteries to change them out were $7,000 a piece. In Lake Havasu, it's so hot that when I would store the boat in a storage unit that did not have temperature control or air conditioning,
kill your batteries.
It smoked my batteries. I spent like $20,000 in batteries just in 1 year because my batteries are beat. Not on top of all the other things. You have a RZR or a side-by-side or a car or all these things that you can store in that space. You're just destroying your product. So, and most people now are looking at boats and RVs as assets, not just something you're throwing money at anymore, So if you're able to temperature control the unit, you're going to get max rent, but people are going to want to buy them and store their stuff in them, or again, cash flow them. So what happened is in phase one, I didn't put a lot of the air conditioning units in my phase one. I did on just a few of them, and it just hit. And so I started delivering my future buildings with all of the air conditioning units, and just people love them. So now they're buying them turnkey. They don't have to worry about anything. They get in, they can get max rent if you're an investor, or you can put your stuff in there and never worry about it, and you're in good shape.
Yeah. So you mentioned with the storage, you can customize this and even add a kitchen, bathroom, and maybe even a place to live. Initially, were you thinking that you were going to be doing these 2 to 3 bedroom man caves with the storage?
No.
Or this is something that slowly evolved as you tested more and more?
So it really morphed, right? So like when you're building storage, legally you can't really live in there. You can't stay there, right? So it's not zoned for it. It's not engineered for it for safety. You don't have the fire protection for it. Like everything about a storage unit is not, in essence, safe for you to live there,
Sure.
right? What happened was in this particular location, kind of the stars typically aligned for.
And just to be clear, this is in Havasu.
This is in Lake Havasu on the
Okay.
north side of town. So what ultimately happens, all these stars kind of aligned for me. So I bought my land where my Paradigm storage is right now. That's 225,000 square feet, five phases, and it's 208 units. Okay, so they're massive units. It's a big project. Right next to it, the original landowner that I bought my 14 acres from also was selling 18 acres. In the city, they have a moratorium for the next 5 years. You can't build any more storage units. But I did what the developer was going to build right next to Paradigm Storage was so ugly that I'm like, I can't have that product next to my storage. It's just not going to work. And mind you, this isn't probably the best part of town from a development side. I share a property line with Home Depot, 90 degrees across the highways, the airport. I have 730,000 square feet of retail. I have Walmart, Dillard's, JCPenney, movie theaters, Buffalo Wild Wings. I mean, name it, right? So it's a really up-and-coming area. So I knew from a density bonus side, this would be huge.
But how did you get around the moratorium?
You're going to love this. So when I started, after I delivered my phase one, it was funny because I had two things. I went through my purchase contracts for my phase one, and one thing I noticed is the amount of women that were buying my units. One of them was a personal friend of mine, so I call her name's Nancy. Nancy, why are you buying a unit? She goes, well, my husband and I both retired, and we've never lived in the same house and not had to go to work.
Yeah.
He annoys me. I want him to go somewhere else and tinker. So I want him to go there and buy. But when I would run into everybody that owns these things, they're like, well, we would love to stay in them. And unfortunately, I have to say no, right? So what happened was I was like, well, I just finished a 3-story townhome product just outside Denver. And then there were attached walls, 4 units per building, attached walls, 3-story. And then I also am building a 3-story apartment project right now. So I'm familiar with the 3-story product. And so I said, well, why don't I design these buildings out of steel buildings? So a steel building barn dominium, because that's trendy.
Sure.
And I built a barn dominium in East Tennessee. I'll tell you that story later. And it just took root. On top of, if I could build a product that's more dense for a higher dense area, I'd probably have a good bet. So one of the big concerns I had was, this was now prior to the elections. We didn't know which way the economy was going to go. I want to make sure that I'm building something that's more attainable. If things get worse from an economical side, people are going to have to migrate into affordable spaces. So I looked at it from a lens of building something that people would love, but it's affordable, and then you could plop these all over any lot around the country, and it's to code, right? So max fire protection, whatever you need to do. So what happened was when I knew there was a moratorium, I'm like, well, and these people want to live in them. Why don't I just build another boat and RV storage garage man cave on the first floor that you could drive all the way through, so garage doors on both sides, make them a little bit longer, 70 feet deep. And then when I do an elevator and do a residential living space above the boat, above the garage.
With elevators.
And go, with an elevator and get a 3rd story in there to be able to get the square footage to actually have a real house. So we were able to get to 3,400 square feet, 4-bedroom, 4.5 bath houses. So you go up to the 2nd floor, you have your main living space, your kitchen, bathroom, 3 bedrooms with so each bedroom has a bathroom, and then you have a powder room.
I
so
didn't
that's
realize
upstairs,
these were
2nd
this
floor.
big. 3,400 square feet?
Yeah.
That's massive.
And then you have a 3rd floor that's a master suite, your
I was
own
thinking
master.
like 1,200 square foot
No,
townhome
so originally when we did our podcast last time, that's where it went, but then it morphed. And the reason is because...
The progression, man. The growth.
Yeah, it morphed. And really the number one reason why was because the way that lenders would look at that, it wasn't really a single-family resident. It was too small compared to the garage, and it was above the garage.
So what would they call it, like a condominium?
They were calling it they were an industrial building flex space is what they were looking at it as. Now, the problem is the biggest concern, and this is where we're kind of getting into the bolts, and I don't tell everybody this, if you think of a house in Havasu, or think about a house that has an RV garage. The RV garage is always next to this living space. So you have a firewall. Everything always centers around fire protection, right? Saving lives. You have a firewall, which is much cheaper to build, vertically than it is from a horizontal side, especially if you live above it. So what happened is if I'm putting living space on my 2nd floor or above the garage, when the garage now has RVs, boats, dirt bikes, side-by-sides, you have a lot more fuel, a lot more combustion inside that space. Therefore, it's more dangerous. So the lid, which I call my lid, between the first and second floor, as thick as these beams are right here. I have basically steel that goes from here, from this lid to the very top of the floor of the second, and then I have fire protection insulation in between that. So if fires go off, you can get out of the house and all that fire will stay contained. Okay. So, but that was something we had to do to be able to go vertical above the garage. That's an RV garage for compliance. So we were like, shit, that's going to cost so much money.
Why is that like the fire protection? Why is that more layered than like a standard 2-car garage would be for a standard resident?
It's just simply the material that we have to put in, because the way that they're going to look at it is, okay, if you had a 2-car garage, you can only fit so much fuel in a 2-car garage, 2 cars. But if you have an 8-car garage and you have living space above it,
I see what you're saying.
You need more protection.
And some of these boats carried 400 or 500 gallons of fuel.
Mine's like 300 gallons of fuel in my center console. It's a lot. And usually yours is more. But I mean, it's a lot.
$790 for the new one.
So imagine having a couple cars, a couple side-by-sides, 2 boats, jet skis, golf carts, whatever. People have all their toys in there, and if something happens, it's all going. It's going fast.
Okay, so that makes sense. So you created this 3,400 square foot. It fits up to 8 cars, boats, RVs, whatever you want. What is the cost of this to the consumer now?
So we have a 3-bedroom, 3.5 bath product, and then we have a 4-bedroom, 4.5 bath product. We are ranging anywhere between $850 to $1.2 million.
Dude, that's a freaking steal.
Yeah, we have. So out of which,
how do you even I'm just thinking, how do you even build all that for that cost?
It has to do with your land acquisition price and really what we're trying to do to create. So to kind of give you a bigger picture.
What is that on a price per square foot?
I'm building it at like $270 a foot.
And selling it at those numbers.
$393 a foot. So I can get up to like $426 a foot. So all the other comps in the area.
And if you factor in the square footage of the garage.
No, you don't.
No, but
You're
if you did, that's like, that lowers the cost.
Yeah, absolutely. So people are going, well, hold on. I get all of this garage plus the living space, and then my purchase price is based off living space, and then I get that size of garage too, like I'm in, and an elevator, right?
Totally.
So people are like, this is killer, but the views are insane because it's overlooking a lake. And then I was able to get a density.
Too?
I do. Yeah, I got all of the product, or all of the project.
I got to get out here to tour one of these.
You could. You should. I'll put it in perspective. As a guy like you that raises capital, one of the things I did not expect was the amount of buyers that were going to become investors. So what happened is my investors, these are people I typically know. They love the barn dominium. They love the design, and the design's beautiful, but of course I'm biased. But what happened was the people that know Havasu know what the cost is for a home to get something of that caliber. They're like, I'm going to be in the 1.4 range, 1.5 range, 1.6 and up to get something of that square footage size and the garage. So what happened was I started marketing, my investors were not only wanting to buy a unit. What we were doing is we went to our securities attorney and said, hey, listen, our investors always have first right to buy a unit. Why don't we allow them to pick their lot, put up an X amount of money, it locks in their lot. I use the capital to develop, right? Equity capital. And then what I do is I gift the equity and profit back to them, and they don't have a capital gains event. So now I'm gifting the equity profit back to them as a down payment. They keep the house, and they don't have to worry about capital gains on the profit. So I have 1,200 buyers on a waiting list to buy these units. Out of 93 units that we've already, that are slotted to be developed, we have 43 of them already accounted for by investors. And so now we have a fixed price. We know what we're selling them for. And now we know what a fixed returns are going to be. And now we already know what we're giving them a down. So it mitigated risk.
Dude, that's genius. So say this again, just so I'm clear, the listeners are clear. So if someone's listening to this and they want to go buy a man cave with you out there in Havasu, how does it work?
So this is like high level strategy that people are probably going to want to see on your podcast.
Let's say someone wants to drop 1.2 on a 3,400 square foot man cave.
Okay, so think of it, and it's a single family house, so you can get conventional mortgage. That was one we kind of surpassed that. But the idea was to design this in a way where I can get conventional mortgage finance. It wasn't just a flex space with like some living space, and now your purchase price is $500,000, and you can only go after cash buyers. We wanted to be able to make sure that we opened up this product to get conventional mortgage and leverage. That way, my buyers pool get much bigger, right? So that's why it morphed to be a full-on single-family detached product. But to go back, what the idea is to figure out a way to allow people, because right now, as you know, tax strategy is key. Healthcare, tax strategy, lifestyle, that's what every investor's looking for.
Taxes is the biggest expense for 99% of people in America.
So if you can figure out a way to invest your money and get tax-free returns, okay, I got your attention.
That's the game.
And they want it, but so a lot of the people, that's because it's such a retirement community, people are planning their retirement. They have their 401ks, they have IRAs, maybe from it. They're starting to plan their retirement. So the way that we marketed this was, why don't you come in with $100,000 investment? The returns are it's 31.5, but let's say 30% for conversation purposes, 4 years, 30, let's say $30,000 a year times 4 is $120,000 in profit, right? It's a projected profit. At year 4, we gift you that $120,000. You already have $100,000 down. Now you have $220,000 as a down. You can go get a conventional mortgage with that, So you may have to come up with a little bit more.
Now, do they have to wait to close?
They have to wait to close. You have to build them. So I have to build them.
They got to wait anyways.
Yeah, they got to wait anyways.
Got it. Okay.
So, and they're like, well, it doesn't matter to me. But now what I'm doing is, because ultimately investors are investing into the LLC. The fund is just a disclosure document. They're getting ownership in the LLC. So if I gift them the equity, they're still owning a portion of that property. I'm just giving them the APN in essence and the address, and they keep it. So therefore, what's happening is the tax, the capital gains, which really isn't capital gains, is I'm delivering them the unit. I gift them the down payment, and then their $100,000 that they used originally is also pledged for the down, and then they just get financing for the delta. So most of our clients are coming in with $200,000, $250,000.
And after you gift them the funds for the down payment, they get in their property. Do they still remain on as investors in the funds?
They can,
or
yeah.
Or they cashed out?
No, so at that time, they're exited because we're gifting them all the equity. The majority of our clients, though, have reinvested. So a lot of times they'll diversify, or they'll go, hey, Ryan, you know what? We're going to pay cash with a different entity, and we'll just keep our money rolling with you if it's an IRA, because they'll just rotate it because they're not getting taxed on that either. So it just depends on the individual. A lot of them, people are really, deferred sales trust is a big deal right now too. People are looking to exit businesses, that type of stuff. But we're kind of getting all walks of life.
Yeah. So when you came on last year, your price point was, I believe you had a couple of price points, like somewhere around 4 something, and you had another one that was around 700, correct? How many of those did you actually build and deliver?
Not one.
Not one.
Okay. Again, going to the city and listening, they don't want storage. Really the biggest issue was the finance options. There was no finance options if I stayed in the commercial space and just went with like more of a bedroom, bathroom kind of studio product. I couldn't find financing for that. So I had to rezone it, go with a, high dense resi, and then go bigger in the residential and eliminate the storage for the city, because the city doesn't want more storage. And that's political. They go, well, that looks like you're building a storage unit.
Is that to protect the other storage operators, or what's the reason behind that?
No, it was just there's so much storage out there.
They just don't need more storage.
It's everywhere. And to be honest with you, the demand is still there.
Is that the biggest risk to getting into self-storage is oversupply?
Depends on the area. I think, so like in 2008, Havasu got hit really hard because it was a second home area, right? It wasn't so heavily invested into retirement like it is now. Like kind of like same thing as Vegas. Vegas was really designed in 2008 around gaming. So when the market crashed, that's why Vegas was like the foreclosure capital of the country. Same concept. However, now that, you have a younger generation that can work from home and so forth, you're seeing a whole different movement of home ownership out in Lake Havasu. And a lot of these people now are, our age, that have 1 or 2 toys and also have kids. So it's the demographics has shifted so much over the last 10 years, and really specifically since the pandemic. So, it's just boomed, but the city is they've allowed so much storage to be built. And don't get me wrong, they're all packed. They just don't want to see more developers coming in to develop more storage. So they just don't like the way it looks. Now, our product, they love it. In fact, they use us as a example to allow other approvals for other type of products, whether it's color schemes or, we have, stack stone on the front of our, they want more, like I have date palms in front of mine. So our landscape's nicer. So they're using us as an example of what they want developers to start building out there, So we get a little bit more flexibility. Yeah. We're the larger commercial developer there. So obviously they're getting a lot of tax revenue from us. So we get a little more insight on what they can and can't accept. So that's why ultimately, though, going after what we designed as far as the barn caves was just huge for the area.
So before we move on, give me like an idea, like visually describe for a buyer looking to get into buy a man cave, whether it's What are the two square footages? 3,400
So
and
yeah,
what's the other one?
We're hovering around because we can move some walls around. That's what the beauty about having steel buildings.
Yeah.
You can move stuff around and can have open more space.
Semi-custom.
Yeah.
Yeah. So what are the two square footage options?
So we have a 2,400 and another one at
Got it.
3,400.
Okay, so breakdown. If someone's listening to this and they want to buy a 2,400 square foot man cave, describe what they get.
So, and I'll back into this because I think this is probably some of the most important parts. So there's 6 phases total of this project. The very first phase, so let's back into this even further. When you're in the heat like that, you have to build a community center with a pool. Period. End of story. It's too hot out there not to have a pool.
Yeah, what are we looking at? 120?
Yeah, dude. It was usually it's like 117 to 120 during 4th of July. We got lucky this year, but I mean today it's going to be like 117. Yesterday was 117.
I used to do air traffic control for 11 years, and when I was working at LA Center, I worked in an area that was out east. It was like east and west side of Vegas. But one of the airports we ran approach to was Laughlin in Nevada, and there was an airline that would go in there. I forget the name of it, but it was a regional airline, and it's the only time this ever happened to me. But they literally called me and they're like, "It's too hot to land."
Yeah,
like they had a 737 full of passengers coming from somewhere, and they literally like circled around and approached for like, they tried 3 or 4 different approaches, and they said, "Hey guys, it's too hot to land, and
our speed's too high.
We're running low on fuel, so we got to divert." So they diverted to Vegas, but I've never had that happen except one time in my 11 years to where the airplane was like, "It's too hot to freaking land."
It's common.
So how hot are we talking, bro?
Oh, so we've had 122, 123, 127 even. I mean, it gets hot. It's almost
sizzling.
Yeah. So to build a community that each unit doesn't have a pool, right? Because these are smaller lots, they're closer together, 10-foot setbacks. They're a little bit closer, so you don't have the option to build a pool. So I knew that I had to build a community center that had a pool. So what I did is I started looking at and doing my numbers and looking at the pro forma, looking at insurance costs, maintenance, all the stuff you need to do to maintain the community center was so expensive that I'd have to pawn off the HOA costs to each unit owner to maintain that community center. And it's way too much. It was going to be like $400 and some a month for the HOAs, right? I think that's insane. One of the things that has helped us with Paradigm Storage is our HOAs are like $15 a month. People are like, "That's
$15?
awesome." Yeah. So my storage units are $15.
How do you get the HOA so low?
It's because the more units you have, the bigger the project, the cheaper the HOA. And the reason is because your HOA is a fixed cost. You have trash, it's standard cost.
But isn't it going to cover the maintenance and to operate like the pool and all that, all the site stuff?
So the more units I have, my fixed costs are X, but the more units I have, I can divide that cost over multiple units, right? So what I wanted to do with this, I have, let's just say in essence 100 units, my HOA costs are $400 a month. That's way too much. Nobody's going to, I don't care if you're a billionaire, people hate paying that much in HOAs. So I looked at it and go, well, why don't we do kind of the Lifetime Fitness movement where they ultimately are, multifamily developers? Why don't I just not build a community center for the residential, meaning like have a standalone building for them? Why don't I build a huge gym that's open to the public? Now the gym is generating income. Like, so from a commercial gym, it's an income approach. Now the building has value because I'm generating income. I go much more extravagant in that venue. So now I have
people can get
Arsenal
day passes,
equipment, dude,
memberships. Yeah. I love that idea. Actually,
so now you have Arsenal equipment. I'm hanging a Lamborghini as a chandelier in the middle of the gym. I have like what kind of
Lamborghini are you hanging from the top?
A Aventador SV. It's like one of 630, I think, in the world.
Damn,
yeah,
this is your Lamborghini.
It's mine.
Damn.
So what the idea was
what's the name of the gym going to be?
Paradigm Gym.
Okay.
Yeah, we were going to look at other operators, but to be candid, it's a little more desolate for that, and I don't think a lot of big operators will come out there. You have Planet Fitnesses and you have some of those, but I wanted more of a private operator.
How far outside of like the city of Havasu are we talking?
Oh no, it's in the city limits. Yeah, it's right next to the mall.
It's just because Havasu's more rural.
Yeah, so you're 2 hours from Vegas, you're 3 hours from Phoenix, right? That type of stuff. But
people are gonna come out there. They're gonna get day passes.
Oh yeah,
you probably charge $50 easily a day pass there. The locals will get memberships because it's gonna be the sickest gym in town. And by the way, it's an amenity for all your owners.
If you look at like the existing gyms that are there, like the larger corporate gyms, they have 11,000 members, 5,000 members. They're top tier in the country. It's wild how many members these gyms have. But if you go in there and you look at the product that they have, and I don't want to talk bad, but it is not to par of what people are looking for today. So I'm just becoming more modern. I'm bringing a modern spin to it. So, for example, I have a eucalyptus steam room, red light therapy, compression. We're doing the cold plunges, and then you have a pool. The pool itself is a Dubai-inspired design pool called Club Drift in Dubai.
Club Drift, okay.
So I'm actually building and mimicking that exact pool, which is the #1 beach club in the world. So I'm bringing that PR to the game. And
I didn't know that was the #1 beach club in the world.
Yeah, it's the #1 beach club in the world. I'm building them. I'm mimicking that exact pool.
What's it called in Dubai?
It's called Drift Beach Club. So you can look it up on Instagram. Yeah,
I got to check it out.
Yeah, so
I saw the renderings of your project though. The pool, the gym. It looks phenomenal.
Oh yeah, it's a 2 stories, 32,000 square feet, 2 stories. We have a parking structure, covered parking, solar. I'm passing all the tax credits over. It's about 32,000.
Got it. And you said you're passing what with the
all
tax?
The tax credits, because we're doing solar, and we're doing a cost seg. So I'm taking all of the tax credits and pushing it over to all my investors. So my investors are pumped, as you can imagine. So that's going to generate cash flow. So think about it this way from an investment hat, right? Now my phase 1, I'm opening up a product that's going to generate cash flow, right? So if I have any cost overruns on construction, I don't have to do capital calls to my investors. And one of the biggest concerns when you are in conversations with investors is inflation, cost of construction, materials, problems going on with China, trade. It's the cost. Those conversations are what's really going on. So if I can figure out a way to cash flow this asset prior to going vertical on the man caves, the barn caves, now I have the ability to push more capital in there that it doesn't have to come out of my investors' pockets. So my projections can stay on point. Now that asset too, by the way, is valuable. I can cash out of that asset and push that money back into the deal if I need to, because ultimately...
What do you mean when you say cash out of the gym and push it back in?
So let's back into it a little further. Let's say think of like a regular residential community, let's say a tract of homes that have 100 houses, and then you have a pool as a community center, right? And you have a little spot where you can play pool and you can watch movies or whatever. That building has no value because it doesn't generate income. It's just an amenity to the residents, right? When you take a building and you separate it, and now you're generating income from the public, that building now has value. It's off income approach. It's a commercial asset, and it's generating income. So now that building has value. So what we did is, instead of having a community center that's just tied to the residents, we separated it from the parcels to 2 different parcels.
Got it.
The residents still have access to it. It's all part of it. But now the cost to maintain that gym doesn't sit on the balance sheet of the HOAs. So it's as if they get all of this. So the residents get this gym, they get this pool, they get all this stuff for free because it's not sitting on the HOA balance sheet. But the gym now, from an investor's hat, the gym now is creating cash flow. The building has value, so the projections are higher. And then now I have a cash flowing asset while I'm under construction for the rest of my phases. And now my investors will feel more comfortable to participate because I won't have to do capital calls. Or if there are cost overruns on construction, I have the liquidity to keep advancing.
And how long will it take you to get through all the phases? And
so about 4 years.
4 years. And so after 4 years, what's the plan with the gym? Will you sell the gym?
We're going to keep it. So it's an asset that Paradigm will keep under management. So that'll be a cash flowing asset for Paradigm. And we're set. So think of like what, Gold's Gym got bought out by EOS. That's a private equity structure. When you look at Gold's Gym, there's only a handful of Gold's Gyms that actually owned the real estate. So if you own the real estate, like McDonald's, you own the real estate, there's a lot more value. So if I were to take the gym and separate it from the man caves and say, hey, I'm going to keep that as my GP equity, is what I'm doing, and then I decide to exit that gym down the road, my valuation is going to go through the roof, not only from a cash flow perspective, but I'm pushing in real estate as well, which also has green building material. So now you have a much larger tax strategy for a large family office.
The gym industry is tough, though.
I don't have any plan to play it. I'm bringing all the different people in to manage it.
Yeah, but in this regard, it makes sense because you're cutting down on the expenses for the HOA, it's cool. It's funny because out in Catalina, I go out there all the time. We're just talking about going out there on the boats, and I'm out in Catalina all the time, and I've noticed my girlfriend and I work out all the time. There's no good gyms out there. There's a big gap in the marketplace, and so I thought, man, I'd love to own a boutique hotel out there that has a couple retail locations and convert the retail into a really, really sick gym and bring all the best marketing, social media influencers, and have like the really dopest gym in Catalina. So not only people staying at the hotel would use it, all the people staying at all the surrounding hotels would come work out there, get day passes. You could probably sell day passes at $50 a pop. Plus, all the locals would get, annual memberships. And so I thought that would be an awesome place. So it's funny that you mentioned that.
You're a smart guy. Look at, the data of the amount of tourism that's going out there. That's all you have to track, right? Because that's really Havasu is a tourism location. When you watch if you watch that and you're like, well, there's no gyms out here, you can create a product that everybody wants and needs. And health and wellness, if you look at the healthcare alone, I mean, from a baby boomer's perspective, healthcare is the fastest growing industry. If you look at gym memberships when the market crashed, just like alcohol, went through the roof, it's the same concept. When you have divorce rates at this high, you have lifestyle like Instagram.
More people are getting in the gym?
Gyms are blowing up.
Really? I didn't know that.
Oh, dude, it's
I didn't
wild.
know that.
Yeah. So that's why you go to
say
like
that one more time. Say that one more time. So when you go through a recession, divorce rates go up, and
so divorces, gym memberships go through the roof. Alcohol sales go through the roof
in a recession.
Yeah, and well, think about this. Have you noticed why there's the public companies for like pet food and cat food and all that's going through the roof right now? Is because they're saying that by 2030, 50% of all women over the age of 30 will be childless and single. Right? So the world's shifting so much. So how many people do you know have dogs now? Think about every apartment project now is dog parks. And I mean, I'm building 2 dog parks on my project.
Yeah. And
right?
and what's the theory behind this? So as people own more dogs, more people remain single? Single
people own more dogs. Yeah. And so, or cats or animals.
You think?
Loneliness. And I'll be honest with you, I went through a divorce. Unfortunately, I'm on my second divorce, and I've even recently thought about getting another damn dog.
I'm sorry to hear about that.
It's rough.
Yeah.
But a dog would help me,
Yeah.
So it's true. It's what happens when you're lonely and it gives you a reason to, so when you look at
do people that have dogs have less of a reason to meet a partner because they already have the dog to provide them?
I feel like it's probably a bigger problem in the dating world. If you have a dog, you can't travel or do anything, and depending on where you live. If you have someone to help you, you have to stay home. Yeah. So that's one of the reasons why I'm not, just because I'm so busy. But anyways, yeah. So, and then you look at even, makeup products and so forth. It's booming because
in a recession.
Whether it's a recession or not, it doesn't matter. That whole industry is exploding.
Damn.
But mostly when market does hit. But if you just look at the trends overall, like for example, we watch spending habits. So one of the biggest things is I watch every generational spending habits, whether from baby boomers, you're starting to see baby boomers, depending on age group, starting to spend a little bit more money in healthcare. They have to, right? So you're starting to see those shifts. And so I am just playing chess on which way the world is going based on people spending their money. And so if you have people that are traveling and they were going to Catalina, which is a big spot, it's like Temecula, wine country, right? You have 22 million people in Southern California. Yes, you want to go to Napa, but you can go an hour drive or 2 hour drive and you can get to a winery and you don't feel like you're in California. It's the same thing when you go to Catalina. You could hop over there with a ferry or have some friends with a boat or take a helicopter, whatever you want to do, and you're there and you can hang out. So that pop growth is massive. That tourism is just growing like crazy. So I think if there's no gyms out there, if you opened up one, all of the hotels are going to love you because it gives them more reason to stay. Right? So there's maybe another play there.
100%.
Yeah.
And then we can market it as like a health and wellness, hotel, and that health and wellness space right now is really trendy. But to take it a step further, because Catalina is so isolated, most of the business owners out there, hotel operators, restaurant operators, are locals and very mom and pop mentality. And so there's not a lot of competition, very old school. So I know a lot of the biggest business owners out there, and those folks own the majority of the restaurants and even hotels
they
out
have a
there.
Monopoly.
And so what they're telling me is they're like, yo, Rich, there's no competition out here. If you can provide a good quality service, you can run everyone over. And there's just not a lot of good boutique hotels out there. And so millions of travelers every single year, less than 5% of the people stay on boats. That means 95% of people going out there are staying in hotels. There's no good product out there. And so if we can bring that and bring a good fitness solution to the health and wellness space out there in Catalina, I think that we could do some numbers.
Joe, what you showed me, what was it? Fusion?
So if anyone's listening to this.
$110 million gym.
Damn.
Where at? This is Miami, New Jersey. So you're going to see, when you look at what's going on in the gym space, it's exploding. So if you started if you were to build anything like, especially a boutique, like your focus, your niche, you have an amazing niche, by the way. I've always given you a lot of kudos because you're slaying it, but it's because not everybody else wants to play in that space. They don't know how. But if you started, my opinion, if you started implementing some more of that health and wellness space in that, you're going to probably have more people stay longer because they have the access to that. Like if you go to the Montage or you go to you're seeing that they have all these different fitness classes and they have all these things, but they're making it a big deal. And so now the wives and husbands, whatever, they go and they do the fitness and they have more. So you're seeing the health and wellness stuff is really picking up. And then you just, let's piggyback off of some additional data, kind of from a political side. When you see what's going on with big pharma, people don't believe in big pharma as much. People aren't believing in government as much. And with everything with the pandemic and getting the shots and all the people just don't believe it anymore. So physicians are telling their doctor or telling their patients, just go back to working out and eating clean. So that you're seeing that also being a driving factor to increase health and wellness.
And social media is a big part of that. People are putting that information out there because the media world is, as we know, is very controlled. But people are, voicing their opinions on podcasts and talking about what really works and what really doesn't work. And so big pharma, I believe, is getting exposed. But back to the man cave thing, walk us through. If someone wanted to go buy a 3,400 square foot man cave, we know we're going to get the pool. We know we're going to get the Lamborghini gym. But what are they going to get in terms of all the other stuff that come with the man cave?
So first of all, what we're trying to do too is we're trying to put actual pavers down on the driveways. So it's in our budget to pave the whole driveway. So the look of it is stunning. The driveways in between the RV garage sides are 60 feet wide. So boats and RVs and the trailers are getting bigger and longer. So we made larger driveways.
How big of a boat can you fit in the garage now?
70. I mean, you can put with a trailer in your tongue, 70 feet. And I think it's really
that's a big boat.
It's about 70. It's really 74 feet deep. I'm just telling everybody 70 feet, but we're giving them an extra 4 feet. So they're 74 foot length in units. Now on the opposite side of where the RV garage is like a standard, let's say street, like a 20-foot wide street, and a standard 2-car garage. So it's more for like economical everyday use. You just pull your car in, get in your elevator, go up to your second floor, take all your groceries, go up. Now I'll give you a backstory. So when the pandemic hit, I moved my headquarters to Nashville out of Temecula. And when I moved my headquarters to Nashville, this was early on, so office wasn't getting nailed yet as far as it wasn't a talk yet because the balance sheets were okay. When things started getting bad, I was already in Nashville in regards to office. So I was, at the time, what I did is I rented a little apartment downtown Nashville on Broadway, right above Whole Foods. I had my grocery store there. And I fell in love with the place, but what I learned was how actual easy it was that these developers got smart on how to build high rises, but make it feel like you're in your own little house. And what I did was I got a parking spot that was right next to the elevator shaft. So when I would park and I'm going up to the 21st floor, I would just grab my things. I would only take 5-6 steps. I go into the elevator shaft. I get on the elevator. I go up. Another 10, 15 steps, I'm in my front door, and boom, I'm right there on my kitchen counter. So I wanted to build that same feel where you go up an elevator, but as soon as you come off the elevator, you're right there in your kitchen. So it's actually easier than walking through your house or from the front yard all the way, to dropping stuff off in the kitchen. So I created that feel there. And then one of the big things that I think people like is that I built the master suite as its own private third floor. So that is just massive. So you have 2 walk-in closets in some cases. You have a shower that's more European design. So you have the bathtub and the shower all in one enclosure. You have views out the back in your own private balcony.
You said water views, right?
And some of them have water views. It also depends on which phase you want. If you want the master to get water views or if you want to have the water views from like the living room.
Yeah.
Because the living room's stunning. I have big sliding glass doors, 26-foot vaulted ceiling. Big balcony that hangs out the front of the RV garage. But so for your guests, if you're drinking coffee in the morning or eating breakfast, you could look out that way to the water too. So it just depends on which way.
I love a water. Once you have a water view, you can't ever go back.
There's a reason why they call it the $1 million views, man.
Yeah.
Yep.
And so with the garage portion, let's just say someone had a smaller RV or maybe a boat that's only going to take up half of the garage. What do you see in some of these folks wanting to do with the other portion of the garage? Because to me, it sounds like perfect for like more living space, right?
Oh, dude. So in my man cave,
you can finish it out.
I don't know if you ever saw it. Have you seen the one I built?
I've seen renderings online from like the stuff you got on your website.
So I have a full gym. I have all black on black Arsenal equipment. I have 2 racing simulators from Podium One. I have a golf simulator, full bathroom and shower, full podcast studio, kitchenette. Literally 2 air conditioning units in there. So that's our office.
And this is where you joined my mastermind community call from, right?
Yeah, I was in the same one. Yeah, so when we did that, I was in that same cave. Yeah, so that's just a fraction of what people build.
Yeah.
The other side of it, and I think this is pretty neat, and I didn't think of it until later on, people were asking me, but, like let's say you don't have a lot of toys, but you live there, and everybody has friends that come to have us. So if you have some extra space, rent out, some of that space to someone who's going to give you $500 a month to park their boat in there.
That's big.
So that's a big deal. So now you're cash flowing your own garage, and when you're not using all that space.
What does one of these man caves run?
So which one?
The bigger one that you're alluding to. So
the one you live in, or the one that
the one that you live in, 300 to 400 square feet.
You're going to be anywhere between 850 and 1.2. The ones that I'm building now, that are the ones that we're 75% complete, but those ones we're selling the 28 by 60. So you have a 20-foot wide, double wide RV garage door with a 14 feet tall with a man door right next to it. So that's inside is 28 feet wide by 60 deep. I have ones that are bigger. But those are kind of more common.
And how tall is this man cave?
These are 16 feet.
Yeah, 16. Okay.
So think about in the man cave, the barn dominium barn cave, it's the same thing on downstairs. So in essence, when you go up the elevator, you're going up onto that second floor. So when you live in a high rise, how beautiful! I mean, there's nothing like living in a high rise. But when you go up into that second floor and you go out onto your balcony, it's masculine. I mean, you're up there. You're almost 3 floors already going onto the second floor. Then you go to your master suite. And you go out the back, you're up there. It's beautiful.
I love it, man.
Yeah, and then what I've done
I got to get out here and check it out.
Oh, you're going to love it. So even like all of the lights that go on the side of the garages, now you can just flip your lights on from inside the garage. All of those lights are going to be ran off the HOAs, which is all based off solar anyways. Every light on the side of the garages on every single street will be on every single day. So at night, so when you're going down there, every house is lit up, and it's the HOAs that cover it.
So now what about your personal residence up top? That electricity you cover, or the HOA covers it?
The units come with solar.
So the HOA covers all electricity?
Yeah, wow. So the HOA covers. So the idea is to cover like landscaping, all that stuff. Obviously, that's different. We're trying to cover the majority of those management fees, which mostly is electric, is going to be with solar. So we can't, unfortunately, the way the power company works there, we can't store power to an extent. There's only so much we can store, but you can't do 18 hours or 36 hours storing. You can run 12-hour storing. That's pretty much all you can. So all of the lighting at night can be completely lit up, and nobody will feel that on their HOA costs.
Yeah, I love it, man.
So you remember we have a dog park, with 2 dog parks, all that stuff. So it makes it all nice without having to pay for it.
Sick. How many like units are you going to develop of these man caves? And then talk about the total phases. How many have you sold so far?
So right now we have 43 of them in escrow. We have 1,200 people on a waiting list. We're just waiting to see if any one of our investors, we're in the middle of our raise, any more investors want to pick a lot and invest at the same time. We're just kind of giving them first right. We have 93 units in this phase. I'm in the middle of acquiring. I'm in the negotiation side, which we've already narrowed it down, but we're not closing until January. 37 more acres behind this for a phase 2 because the demand is insane for these units. I just got a revolver approved with JP Morgan. So I'm
What's
looking
a revolver?
A line of credit.
Okay, got it.
So now just to back into it, we went to, the engineer and architect, so the architect on this project was a guy who remodeled the Pentagon, and my engineer for all of the structural steel was the group that did the Dallas Cowboys Stadium. I wanted to design and engineer these buildings in a way that we can ship buildings all across the country and allow developers to white label them. They say the people that made all the money during the gold rush were the ones who provided picks and the shovels, right? So if I'm building a product, which, by the way, your insurance cost for homeownership is much lower than stick-built houses due to the fires and all that stuff. So if I can erect these buildings faster than you do stick-built, now speed is everything, right? Now you're making more money, you're delivering product sooner, but then you can build these in pretty much any atmosphere across the country, whether you're up in the snow or, you're down in the heat. So we wanted to build something of that nature. What's happened is I took that entire model and I went to JP Morgan and said, JP Morgan, I bank private, all my capital's in JP Morgan Private New York. So I went to them and said, hey, look, I'm rotating X amount of capital. We're opening up multiple funds. I have this product I need to sit with you and show you. Once I sat with them and I showed them all of the inner workings, because we're more vertically integrated, meaning I own the construction company, I own the solar company. So it changes your margins and your risk. So that's how these banks and lenders are going to look at risk.
You own the solar company too.
I own all of it, basically. So what's happening all the way down to we were even going to own the manufacturing of these buildings, and that's still kind of in the works. So the idea is to go to them and say, hey, here's what we're doing, but we have more cash flow coming in because we can sell these buildings. So they're looking at us as a whole going, you guys have created something we want to be involved in, even though we're heavy in secondary markets, because most institutions want primary markets.
Yeah.
If you look at the data, though, and affordability, everyone's going to secondaries. It always has always been.
Why is that?
Affordability. And on top of that, when you look at just, unfortunately, healthcare costs, fuel costs, lifestyle, all that stuff, and you watch the trends, they're all going to areas like this. Boating, outdoor, recreational. People love that stuff. Lifetime, basically 24/7, you're doing something recreational. So JP Morgan looked at our model and said, we love what you're doing, but our mandate is for you to build barn caves and the Paradigm storage product. So I have to build 3 different locations. They want the diversification. So I'm looking at Ozarks, and then I'm also looking at a lot right now in Nashville, but it's called Old Hickory. So it's about 30 minutes outside of Nashville. So I'm looking at that as well as another option to build these. So it's morphed into something a lot more than I could ever expect.
Yeah, huge, man. Very sick. So Nashville next, and then potentially the Ozarks.
Yep.
Okay,
I'm actually trying to do Ozarks first because there's a 60-acre parcel we're trying to get our hands on, which there's a lot more moving pieces.
Yeah.
But I want to move on to that one first because I can keep growing. If the demand's there, I have more extra land. So in essence, I'm buying more land than I need. And if it hits, I can either entitle, plan the land, and sell it to other developers, do build-to-suits, or I can keep expanding my product. So
absolutely.
Thinking ahead.
So I want to switch gears here and talk a little bit about your debt fund. I know you do a high volume of lending in the commercial space, mostly short-term debt, I believe. Give me a snapshot of what you're doing in the lending space.
So really, that's really my background, right? So again, after 2008 and kind of repurposing distressed assets, I got to a point where I couldn't manage all the assets from an operator side. It was easier for me to lend the money, and if people fail, then I'll take the property back, but lend the money and get the margins my investors were looking for at the time. So as time went on, I had one big whale, in essence, a family office that was giving me all the capital for my trust deeds, for my lending. As time went on, that guy started backing out and retiring, so I wanted to go and continue to raise more capital because that was my main income, right? So, and I built my network through that. So I went and opened up a fund, and I started raising capital for first trust deed, short-term bridge loans, hard money lending that was more institutionally underwritten. So I'm looking for operators that have a significant amount of skin in the game, that have a track record, products that I can fund and sell the notes. So this wasn't really, I do have a background in doing
you typically sell these notes in the secondary market?
Yeah, and I still can. I still do. So unfortunately, one of our biggest buyers was in Israel. So everything that was going on over the last couple of years has not been good. So we're balance sheeting the majority of our stuff. We do have other buyers, but we don't get commitments from the buyers like we used to. So when I underwrite these loans, I look at them from the perspective of, will they perform? Are they going to put up X more money in interest reserves, right? I'm starting to underwrite differently for risk, but that fund has always been our hamster wheel of capital. Guys like you or anybody else that's developing projects, if you know you can get debt leverage from one phone call from a guy, you're going to call him every time because you know what my cost of capital is going to be. You know how you can call me anytime if there's a hiccup on construction. A guy like me can work with you. And that's where private fund managers are really getting the majority of private capital now in the mortgage-backed security market. Because if you work for a bank, the borrower is just another number. You work for a fund manager that makes all the decisions on every asset. You can call me and say, hey, dude, the election's fourth quarter was so slow for everybody. Like, can you give me some grace on you? I'll extend for you, no problem, right? So there's things like that when you're an operator, you really want a relationship with a debt fund manager.
Now, when you sell these loans in the secondary market,
we still control it.
You still control it, really?
Yeah. So it's just very simple. So have you? You probably know this. If you bought a house or you went to your best friend that's a broker, you buy a house, what have you. All of a sudden, let's just say you use ABC lending, and then you get a mortgage statement in the mail from Wells Fargo, and they sold the note to Wells Fargo, right? Not necessarily. Wells Fargo probably isn't the mortgage-backed security holder. They're just the servicer, okay? So like, for example, I use FCI for servicing. So all of my borrowers get a statement from FCI.
Yeah.
They make payments to FCI, but I own the trustee. I'm the lender. I'm the owner, right?
Sure.
Same concept. So what happens is so it's really morphed since like 2008. So for example, fund control is big. They want to have like lenders, like guys in suit and ties want to buy the mortgage, buy portfolios of mortgages, but they don't want to manage it. So we're smart going, hey, look, we'll send you, you guys get the clip, you keep the coupon. We want a 1% margin. So for example, if I write a loan for 11%, I'll sell them the loan for them for 10%. I keep a 1% margin, which allows me to pay for my back office and fund control and you know, keep my lights on in some cases depending on volume, but it allows me to stay involved into that trade line for the life of the trade line. So meaning, let's say I fund a loan for $1 million
Basically an asset
to you.
management fee.
There you go. It's exactly what it is. But it's not to the fund, it's to us directly. So us for overseeing that asset. So for example, I give you $1 million, right, at 11%. I'll sell that note for 10%, but you still keep in communication with me. So all your fund control, servicing, extension needs, all that stuff, you call me. I make the final decision, and I call that note owner and say, hey, we gave him an extension, we gave him some grace period, what have you. We still have the other servicing side. We still communicate with the actual servicer because that's its own license.
Sure.
But we manage the fund control and manage the relationship.
Yeah.
So
that's
it's great.
huge.
Because you can come to me and go, Ryan, okay, I have $1 million deal, and you're a killer borrower, you're current, you're doing. I'll sell that $1 million. You have come to me and go, Ryan, I have another project. I need another $1 million. I can sell that note, recapitalize that $1 million, give you another $1 million, and now I have 2 assets I have under management for you, but I only used $1 million to do it when it was $2 million in asset.
And you're taking points on the front end too.
And we take fees on the front end. Yeah. So we make fees on the front end. We're taking asset management on the back end. And if there's extension fees, sometimes we share in those extension fees too, but it's in the payoff. Sometimes we want to give that to our it depends on, that's the negotiation skill set there, because you're in the people who own the note. That's where you want to negotiate with them, because if they're extending that note and they're still getting their clip, they're good, but they also want a little bit more for extending, you know. So we mess around.
When you take the fees on the front end, origination, all that, and then you go to sell these notes in the secondary market, does that note purchaser, do they get a portion of any of the fees on the front?
No.
They don't?
No, so you'll see.
So they're just getting the 10% or whatever in this example.
So you're going to see, so look, if you go to like Torac, RCN, you go to all these current buyers right now that most hard money lenders work with, they want a portion of the front end. They're doing table funding now. They're not even buying notes from guys like us anymore. And there's two big reasons. When you say
table funding, what do you mean?
Basically, like, so there's a lot of brokers out there that want to classify themselves as direct lenders, and they're ultimately lying. And what they're saying is they're going out to market, telling everybody, hey, we're a direct lender, come to us, we'll make the final decision if we're going to lend you the money. And if we're in a borrower, you're like, cool, I can get to these guys, they're going to say yes or no, and we're good to go. It doesn't matter. There's still a credit box that has to be followed, right? And typically it's your buyer's credit box. However, what's happening is there's so much fraud that has gone on from a loan officer's perspective. That's why the NMLS came out when we were up to 2008 and tried to mitigate all that fraud. What's happened is there's been so much fraud that's gone on that the lenders are the ones stuck holding the bag. So what they want to do is they would rather underwrite the file directly rather than us as a fund manager, underwrite it directly and participate on the fees on the front end and deal with the docs and deal with everything, get a little bit more money on the front end and not just buy the note off of us and never see anything really that's gone on from the front end, how we quoted, right? They want to know. So these lenders have gotten smarter simply from a risk position to allow these other lenders and loan officers to say they're direct lenders, but they're really not, okay? We're a real direct lender. I manage a fund. So if I have a buyer who doesn't want to buy the note for whatever reason, doesn't matter. I still looked at it as just keeping it on my balance sheet no matter what. I don't care. So we have a blend between selling notes and keeping stuff on our balance sheet, okay? Because if I'm keeping stuff on my balance sheet, I'm actually making more in yield than when I'm paying my investors anyways. This minute I sell that note, the management's still the same, but I make less money per asset that I have under management once I've sold the note. If I keep the note on my balance sheet, I make more money per month, which is fine, right? However, the problem is I haven't recycled that capital, so therefore I don't have more money to make in fees, because where we make all of our money is in the origination phase.
Yeah. And so there's opportunity cost to keeping the note for 18 months, 24 months. And then if they extend,
we get extension
huge
fees.
opportunity cost,
Yeah,
right?
so we're always raising capital and parking money, whether we sell the notes or it doesn't matter. We make more money no matter what when we have more under management. If we have to take back properties, which we're not scared of, doesn't matter. We're going to make more money because typically we're under leveraged based on loan to value anyways. So we don't mind getting our hands dirty. In fact, I just posted yesterday I had to foreclose and take a property back. We're finishing the rehab and sticking it on the market. However, if you look at the margins in fix and flips, they've shrunk a lot, and it's also gotten harder to find fix and flips.
Yeah.
So guys like me go, well, it's okay to keep properties on our balance sheet because we don't have a lot of origination requests anyways. So you got to kind of manage the fund according to demand and who's going to be buying it. So now we've gotten to a point, just like everybody else, little lower leverage, better borrowers, bigger loan amounts, better asset classes in areas where there's more demand.
Yeah.
That's kind of how we're navigating that. So if we keep it on our balance sheet, great. But then you also have those buyers that are like family offices that only want to buy 50 million in notes at one shot. So instead of buying one at a time, they're like, give me your portfolio, maybe we'll buy all of them, which sometimes will cripple us because we're like, well, we don't have a bunch of originations to put the money back out on. So you have to be careful.
What happens to the purchaser of your note when you have to foreclose on a property? You sent me a boutique hotel deal like a year ago, asset that I believe you were taking back at the time. We passed on the deal, but what happens to the person who purchases the note in the event of a foreclosure?
So let's go back like early 2020, 21 when things were booming, right? We have it's a first payment default buyback. So there's a buyback clause in what we call the MLPA, the Master Loan Purchase Agreement. The agreement we have between the note buyer will be, and it shifts all the time based on kind of the atmosphere of the market. But once I offload that note, most of the time we have no right to buy it back unless there's fraud. Okay, if there's fraud, then we have to buy it back. Right now, or before, it was like 90 days. So we would go, especially most of our stuff was construction anyways, round up or heavy construction remodels. So that we would ask the borrower to come in with 6 months, 8 months, 12 months of interest reserves anyways, right? So we would surpass the first payment default and those issues where we would have to buy the note back. In some cases,
So you would just cover it with the reserve capital.
Correct. We cover it with the reserve capital. Now, what we've done though, and this is why the note buyers love working with us. This is actually the secret sauce, to be honest with you. What happens is we say, look, we're not afraid to buy back notes though. So we're going to maintain fund control. Anyways, we're going to know what's going on with the construction. We're talking to the borrower. We're doing inspections. I have pictures, invoices, lien releases from contractors. I have it all in file. If they stop making the payment, we're actually going to be notified first. We actually notify the note buyer first. We know because we're dealing with servicing, right? The note buyer just wants their coupon. So we overall manage it. We'll go to the borrower and say, hey, look, either deed in lieu or we're going to start the foreclosure on you. Which one do you want to do? And a lot of times depends. But let's say we end up taking the property back. I will go back to the note buyer and renegotiate the purchase of that note and buy it back and then take it over through an REO. However, sometimes I don't do that at all. I just go all the way through the foreclosure process, get it up on the auction, it sells, and then the note buyer makes their money. I don't have to buy it back because I will never put myself at risk that way.
We bought one of our boutique hotels, the Lodge up in Lake Chelan, Washington, waterfront, Lakeview boutique hotel, 40 rooms, built in 2021.
Yeah, I remember that, yeah.
And one of our bridge lenders that funds a lot of our deals, we have a good relationship with, they brought us this deal in November of 23, and they came to me and they said, yo, Rich, we got to get this off our books by the end of the year. We think you guys would be the perfect buyer. We moved quickly. They sold it to us at a massive discount and did 0% seller financing for the first 6 months to kind of help us get it stabilized. So it was a win-win, and we were super easy to work with. We closed quickly, and it was a win-win scenario. And that's why I say, one of the best paths to find good deals is to build good relationships with these bridge lenders, because these bridge lenders have deals that go bad, and you want to be first in line to buy some of those deals when they go bad. Now, they're lending to, you guys are typically lending 60-65% of the ARV all-in cost, and so in this scenario, they're in on the initial borrower at 60-65%. They sell it to us for like 68-69% of the actual value. We get a great deal. They're getting a little bit of a spread. who pockets that spread when you sell the note in the secondary market? Is it the note purchaser, or is it you as the servicer?
So usually it's the fund manager or the fund that originally sold the note.
So it'd be you guys in this
It
example.
would be us. But what we do is we push 70% of the profit back into the fund and give it back to our investors in the fund.
I see.
We take 30% of it. Now, if we have to take back a property, we take disposition fees and certain fees just to maintain it and manage it. But once there's profit to be made, whether it's on a standard sale or we repurpose it and go to someone like you and say, hey, we just don't have the time to try to deal with this in-house, we'll sell it to you at a discount from what we ended up originally had from it. We just want to make X amount of money and you take it. There's always going to be margin there for the most part because they never lend max leverage, right? If they sell it to you and make $100,000, we're going to push $70,000 back into the fund. And then my investors get a higher return, and therefore their likelihood of them either allocating additional capital or me showing a track record to go get more money is in place. So I'm, as a fund manager, going, what's the path of least resistance to generate the most cash flow for my investors, make me look good, and get this off and keep the relationship with someone like you tight? And it's a win-win because we know that you know what the hell you're doing. So I know I can say, hey, look, if I have to deal with call attorneys, deal with bankruptcy attorneys, deal with foreclosure attorneys, deal with all, it doesn't make any sense. I would rather give you this for the next 6 months at 0%. You get it repurposed and then buy it off of us for a fixed price. It's actually better for a lender to do that than trying to strong arm all the way through the foreclosure process.
People always ask me, they're like, oh, like, where's the best place to find off-market deals? And they're focused on direct mailers and trying to like get all creative with these sellers. I'm like, bro, go build relationships with all these bridge lenders out there, especially the ones that lend in all 50 states. They have so much product, and all that product every now and then goes bad. And when it goes to the bad basket, if you have a good relationship with that bridge lender, they're going to bring it to you. And that's how we bought the lodge. 40 units, bought it for about $120 a door. You can't build it for that cheap. Lakeview, right on the lake, up in Lake Chelan. Bought it for 4.87 after seller credit. We will refinance this deal later this year. It should appraise between 8 and 9 million, right? And those types of deals are out there if you build the relationships. And that's why I say real estate investing game is who you know and who knows you. So go out there and shake more hands if you're not finding deals. That's the game right there.
And it takes time, though. You can't be this person thinks you're going to do this for like 1 or 2 years, you're going to strike gold. It doesn't work that way. Relationship, that's why they say family offices. It takes years to establish that trust and relationship. So if you're chasing down hard money lenders that have deals on their balance sheet, you need to show that you have the capacity and the ability to get that deal off their balance sheet rather quickly, and that you have a team or you have some sophistication tied to your name to do it. Otherwise, they're going to go, well, why am I going to do that? I'll just call this guy over here that I've been lending 20 deals a year to that I know is going to perform and do that. So you really got to work your way to what you've done and created. But again, that asset class is a niche. Not a lot of lenders have those assets on their balance sheet at all. But if you're going after a niche product, then start looking at the niche lenders and then start hitting them up and say, hey, look, this is where I hover. I have a team. For example, what I would advise some of your listeners, if they want to get in to do it, pay you to be on their advisory board, dude. Right? And then they can build a pitch deck and go to these lenders and say, listen, this guy has done a lot. He's got my back. And then you're coaching them up on how to go out and acquire this stuff and give them some tools
and
to be
have
successful.
That in our boutique hotel mastermind community, which you were a speaker of. But 120 members, 48 hotels owned collectively amongst the group. And so now if you're a brand new hotel investor, when you're talking to brokers, lenders, investors, the first line of your mouth is not, hey, I'm looking to buy my first boutique hotel. It's like, hey, my name is Ryan. I'm part of a boutique hotel investment group where collectively we own 48 hotels. And now the credibility, they're going to take you seriously right out the gate with that first sentence.
Because now you really have the ability to perform. And that people, when it's money driven, you got to perform.
And that's why getting in these rooms is so importantly. But I hear people all the time, they're like, oh, like struggling to find deals. I can't find deals out there in the marketplace. It's like, no, it's not that there's no deals. It's just you're not shaking enough hands. You got to go out there, shake more hands. You got to meet more people, get in front of more people, and not enough people know who you are. And that's it. I want to switch gears here, man. So you love boats. You're in the boat game. Your last boat we talked about on the last podcast, but you just got a new boat. And tell me dude, you were doing, how fast were you going?
I think that one was like 135, the old one. Yeah,
the old one was 135.
Yeah.
And so this new boat, you're doing 90 miles an hour with 10 people on board. How do you pull that off?
So it's a center console with four 450s on it.
Okay.
But it's a 40-foot Sensation center console.
Okay.
450s, and even with about 50% fuel, 10 people on the boat, I'm doing 90, no problem.
So we're looking at a 1,800 horsepower.
Yeah.
How much does this boat weigh?
1,800? Yeah, I think 1,600 or 1,800. One of those.
Four 450s, right?
Yeah. So
1,800 horsepower.
18 hours.
And how much does the boat weigh?
I think I'm wet. I'm 1,600, 16,000.
Damn.
Yeah.
That's a lot of horsepower.
It's a lot, dude. Yeah.
My boat right now. Well, I got two boats right now technically, but the boat I'm selling right now, 18,000 pounds. To put in perspective, it's got two twin Volvo Diesel Penta 300, so it's pushing 600 horsepower, 18,000 pounds. I'm doing 30 knots. You're doing 90 knots.
Well, two different hulls.
Yeah,
and
insane.
two different props, the whole thing. But those are racing motors that are built for that because they're actual V8 turbos. So each motor, so it gets up.
Well,
right?
what does it feel like when you're doing 90 knots across the water?
The best feeling in the world. I don't worry about it. I think it's what's the very first Fast and Furious? Nothing matters for that first quarter mile. It's kind of the same concept. When you get at it, like all your worries, all your stress, all that stuff goes away because you're so focused on not crashing or keeping everybody alive or just enjoying it. Because doing that type of speed on the water, I think what I get a big kick out of is people that have never done that before on the water and they're with me for the first time. Their lives change. Like for the next 2 months, that's all they talk about is how fast they've been on a boat.
Where were you when you guys were? You're taking 10 people out.
Right in Havasu, right in Lake Havasu. Yeah. So honestly, I'm always hosting because I do the same thing you do. And I'm always hosting. I bring people out and take a look at the site and then bring people out and jump on the boat, go and kind of get to know each other. And I'll just kind of look around. I'm like, okay, these people will be okay with me pushing it a little bit.
It's really the best device out there for entertainment.
It's better
networking, bringing investors out on the water, collaboration. I've met so many like high level people out on the water because of the boat game. I was just hanging out with the founder of ClickUp out in Catalina, 4th of July. He had a 105-foot yacht out there, and I'm hanging out with him. And you realize there's levels to the game. This dude's running a $6 billion company, 2,000 employees. We're hanging out on the water, and I've met countless like business owners, real estate investors out there on the water because of the boat, and it's one of the best networking devices out there, man.
Well, when I saw that you got a boat, I knew exactly where you were going with it because my experience is, look, you can do events, which are great, and don't get me wrong, they always work, suit and tie events, what have you, but you're really not being able to provide a culture or an atmosphere for people to bring down their mask.
An experience.
And when you're on the water, there's something very peaceful about it. You're kind of hovered together. You kind of have to lean on each other a little bit. You're kind of in each other's space, kind of uncomfortable, but it pushes you to get outside that comfort zone. But it allows you to start building kind of real one-on-one relationships and having a much deeper meaning and purpose inside those relationships. So I'm now a big fan of not trying to put a bunch of people in a room. I would rather have, a small group of people to get on a boat, kind of go decompress, really get to know each other, get into much deeper conversations, build the trust. And if there's, synergy, then we do business together. I want people to trust and get to know me from who I am, because people aren't necessarily investing into your investment. They're investing into you. They're not investing just, okay, yeah, you have the track record and all the stars have to align, but they're trusting that you are running a team that's following your lead, that you have the knowledge, that you have the ability, and that's what they're investing into is you. So the more you can bring down, that mask of others and your walls along with theirs, you get to know each other, and it seems to be a really big benefit for our firm, and that's what you do. And that's why you've grown so much, is because whether it's the boat alone, it could be a big part of it, but you just have a way of being able to build rapport with people that's just kind of built on like a standard moral compass the world doesn't have anymore. That's what I've always really enjoyed spending time with you.
Dude, I appreciate that, man.
You just have that aura. You just have a lot of charisma, man. You're great.
Yeah, I appreciate that, man. And the feeling's mutual, man. Every time we connect, I'm always like, fuck, I got to do more stuff with Ryan, dude.
Thanks,
good
bro.
dude, good energy, and always dropping a ton of value. But yeah, I got into the boat game a year ago, and I was like, I didn't know how much I would use it. People say, oh, best day as a boat owner is the day you buy it and the day you sell it.
Break out another 1,000.
Yeah, you hear all those stories. And part of that is true. Like, shit that is always breaking on the boats. That's one thing I learned. Shit's always breaking on the boats.
New scratches every time you have a team. It's the way it goes, man. Yeah.
Every time I take her out, there's something new. But I learn every time. It's always an adventure. I'm like, okay, I learned something new about fixing boats.
Yeah.
We're always like problem solving out there in the water. But the memories and the network collaboration is second to none. I use the boat literally all the time, every other weekend. I'm out in Catalina. I love going out there. And then here in San Diego, I'm on her all the time. And so a year later, I'm like, well, let's get a bigger boat. So never had plans to get a bigger boat this soon, but came across I didn't even know this is a thing, but there's yacht charity programs where these like yacht owners will donate their boats and get a big tax write-off. Most of these boats are like older, tired
Is
boats
it a
that people don't want to
nonprofit?
buy it. Nonprofit.
Yeah. Okay.
And there's multiple charities that do it. And so I came across this boat, and it's Explorer Yachts, Italian semi-custom design. This one's 2021. And in 2021, it was 3.5 million. It's a $3.5 million boat. I'm picking it up 4 years old for 1.3. And how it works is you put 35% down, and then they finance it to you at 0%. It's a 0% loan.
So the seller is giving you
the seller will donate it to this yacht, this donation program. This is a children's charity foundation called AMI
that's
Kids,
cool.
right? And we're aligned because I donate money every single year to Big Brothers Big Sisters Charity Foundation. I have a little brother named Isaac. He's 15 now. We've been hanging out together since 2019. So a lot of synergies there. And I saw the boat on yachtworld.com. I call the broker, and he's like, Rich, you never believe it, but he goes, bro, this is a donation boat. It's a killer deal. It's under contract right now. The guy was a straight shooter. He's like, it's under contract right now for this number. He goes, put in the offer at 1.4. He goes, we'll put in a backup offer. He goes, I have a feeling it's gonna fall through. And so I put in the backup offer. They accepted. I sent in the deposit. And I'm like praying every day. I'm like, I hope it falls through. Well, it turns out the initial buyer was going to take the boat to Mexico. It was a Mexican buyer. The children's charity, they don't want the boat to leave the country, right? And so they want it to go to a good cause. And so, I told them that there was some synergies. I do some stuff for Big Brothers Big Sisters. They love that. And so they said, hey, we're going to cancel with that buyer. We're going to give the boat to you. We want the boat to go to a good cause, and we want it to stay in the U.S. So I got in there and, did the sea trial, a couple things that came up. So I ended up retrading it, got it down to 1.3, 35% down, 0% financing, which is insane. And so the boat's being shipped out here from Miami right now. It just went through Panama Canal. It's off the coast of Costa Rica right now. Going to take delivery down to Ensenada either Sunday or Monday this coming week. And excited for it, man. It's going to be sick, dude. I can't wait. So
congratulations.
Thank you. So
It's a big deal.
Be hosting a lot of events on the water. Doing a bunch of cool stuff on the water, and I'm looking forward to it, man. The boat game is fun, dude. It makes me happy. It's like my favorite hobby.
Well, what I'll do is I'll bring the center console down, and we'll kind of tie up and have some fun.
Well, I go out to Catalina every other week, so why don't you bring the center console down, come out to Catalina? It's a 78-mile run from San Diego. It's funny because people are like, damn, you make it there in 2.5 hours on your boat, and I'm like, yeah, the new boat's going to take about 4.5 hours. It cruises a little bit slower.
Yeah.
But you going 90. You go out there early morning, you're going to get out there in less than an hour, bro.
Oh, yeah, we'll get there. Yeah, no, we'll just have fun and kick it and just cruise with you. Why not? Just stay side by side and just get there.
We'll have to make it happen. And I got to get out there to Havasu. I got to come check out these man caves, the development, everything they're doing out there, man.
I was even going to ask you, we're looking at hosting a small event for the community just to teach people how to build their businesses and just kind of give just some kind of overview of how to scale your business, how to, vet the right people to bring inside your organization. I was thinking about having Ray Cash Care is going to come too.
Okay.
So I'll have him come and speak, and I was thinking about having you come.
I'd love to come out, man.
So I'll give you all the dates and see if we can make it work. But I'd love to have you there because I think you'd add a lot of value to that community.
I can help promote it too.
Cool.
We should do something out in Catalina, like some sort of weekend mastermind where you bring your boat, I'll bring my boat, and we can have like a small group of 15, 20 people want to go out there, level up, talk about real estate game, taxes, building wealth, leveling up, all that good stuff. So let's talk about that.
Let's do it.
Ryan, I appreciate you coming on, man, dropping so much knowledge, so much game. Where can the listeners get in touch with you? They want to learn more about what you're doing, but more importantly, if they want to learn more about investing with you and getting involved with your project.
So I'd tell everybody, number one thing to do is go to our website, paradigm.com. We spell it a little differently. Paradigmcompanies.com, Paradyme companies.com. The reason I say that is get to know a little bit about my background. All of my executives are and their backgrounds. I have Wall Street guys in there. I have high-level CPAs, guys that have managed billions of dollars that are all kind of overseeing our operation. And then kind of all the downline of all the people that are also some of the executives on the team. Then look at our track record and then look at our individual investment offerings that we have right now. And I would say that would be probably a good way to get to know us. if you want to get to know me on a personal level, follow my Instagram. Just type in Ryan J. Garland and I'll pop right up. I actually look pretty good in a suit and tie, and that's the first shot. But then it'll kind of give you more of a kind of closer vibe of who I really am from a dad and, as a friend, and all the cars and fun stuff that I like to do. And I talk a lot about just kind of the economy. I'm finishing a second book right now, so we'll be launching that. And really, it's kind of a blend between who we are, the things we've witnessed and seen, kind of the forecast of being more conservative, tying yourselves to the right asset classes, how to get transparency, how to make sure that you have the right people around you, just in the business. So
there it is.
Yep.
So much value, so much game. He's Ryan Garland. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you guys on the next one. Peace.